Hello, good afternoon, everyone, or good morning if you're attending from the West Coast. I'm just going to take a minute here to have a bunch of people still joining us. So we'll just wait a little bit to make sure everyone who wants to join and is trying to join on time can do so. In the meantime, just thank you so much for joining us here today for OnDeck's second bi-monthly webinar. Today we're going to discuss the 5 metrics small business owners absolutely need to know to run a successful business. While I'm sure most of you understand and currently work with some of these metrics, you may not be focusing on all of these metrics at the moment, and we hope to encourage you to take a step back and assess what you, as a business owner, need to know about your company's finances. And for those of you who are not familiar with OnDeck, OnDeck provides term loans and lines of credit to support small business owners. OnDeck uses hundreds of data points, not just your personal credit score, to evaluate the health of your business and can get you funds faster and simpler than going through your bank. My name is Ariel Kranzow, and I'm the content manager and the small business educator here at OnDeck. I've been working closely with small business owners for nearly 10 years in many avenues, from graphic design to creating educational content like this, and I'll be your host today. Now, to get started, and before I introduce our speaker, I just want to take a minute to go over some housekeeping items for today's webinar. First off, there will be a Q&A at the end of the webinar, so if you have questions as the webinar is going, type in your questions to the question box, which should be on the right side of your screen. And I will do my best to answer any questions that you have during the webinar. And if I can't answer it, I'll leave the question for the Q&A at the end with Ty. Also on the right of your screen, you should see a box labeled Handouts. I've uploaded a few ebooks and PDFs that I think you'll find helpful and interesting, and they're available for you to download straight from the webinar. If you don't want to take notes furiously during this session, have no fear. I'll be sending everybody the slides and a replay of the webinar after the session ends, so you'll have plenty of time to go back and check something that you might not be sure of if you don't remember. And if you have any questions that don't get answered during the live session, I will email you, or Ty will email you at the end of the webinar with the answers. And lastly, our next webinar will be covering today's lending landscape and will be on Wednesday, October 25th. And we can't wait to see you there. So now I'm going to introduce your speaker. His name is Ty Kiesel. Ty is the editor and small business educator for OnDeck, and with over 30 years in the trenches of small business as a business owner himself and as an advisor, evangelist, and author, he's focused on making the biggest challenges facing small business owners today accessible and easy to digest. And so now I think we have a bunch of people on the webinar. Thank you so much for joining all of us. And Ty, I think it's time for you to take it over from here, and let's get started.
Awesome. I am really excited to be here, and we're going to talk today about some of the things that I had to learn the hard way as a small business owner. And to start us off, I just want to ask you a question. Why did you start your own business? Hopefully you've given that a lot of thought over the time that you were thinking about starting and as you've run a business. And there are a lot of reasons that people start a small business. Sometimes it's to do something good. Sometimes it's that business owners want to control their schedule. Oftentimes it's the tax advantages, or you wanted to do something that would be a legacy for your family. There's lots and lots of reasons that small business owners start their business. And what's your reason? And we're going to do a little poll here to find out and kind of ask. We've got a couple of suggestions here. If you'll take a minute and give us some insight. So far, 100% of you are well. That it was control your schedule, but that's not the same anymore. This is great information, and we'll give this just another couple of seconds to go through, and then we'll close the poll, and I'll give you the results. It looks like the big winner was you wanted to do something, you wanted to build something successful, and that was 44% of you. 17% had others, so I'm not sure what that is, but 28% you were an expert in your field and you wanted to leverage that into a small business. These are all great reasons to be a small business owner, and it's important to remember why you wanted to start a business. But unfortunately, according to the U.S. Small Business Association or Administration, about 2/3 of businesses that have employees survive for 2 years, and only about half of those businesses are still alive after 5 years. So the cumulative survival rates for businesses by their birth year, is how the SBA describes it, is about 50% survive those first 5 years. And there are a number of reasons why small businesses tend to fail. Maybe there's not enough demand for goods or services. Maybe there's too much growth or not enough growth. Maybe they're undercapitalized. There's lots of reasons why small businesses fail. However, years ago, I came across a book called The E-Myth Revisited by Michael Gerber. And he says that most entrepreneurs are merely technicians with an entrepreneurial seizure. Most entrepreneurs fail because you're working in your business rather than on your business. And I think that working on your business is really important. And from my perspective as a former business owner, I probably spent way too much time working in my business. And so we're going to talk about, what does it mean to work on your business? How do you work on your business rather than in your business? Several years, one of my best friends is a CPA, and he used to talk to me about what he called the profit expert in his business. And he used to say, to work on your business, you need to know what's going on in your business. And to do that, you need a profit expert. And because he was a CPA, in his opinion, that profit expert was the guy that was in the books, the guy that understood what the financial reports were saying, the person that understood just what was going on financially in your business. Now, that doesn't necessarily mean that you have to be an accounting expert to become the profit expert, but there are a handful of metrics that every business should know backwards and forwards, so that they can be that profit expert in their business, because there isn't a better profit expert than the potential you have to be that in your business. So now we're going to go to just another brief poll. And ask, are you the profit expert in your company? And so far, it looks like most of you are saying yes. A few unsures. And it looks like we can close the poll now. 76% of you say yes, you're the profit expert. 18% say no, and 6% say I'm not sure. And it's okay to not be sure, and it's okay to not be the profit expert as long as you have one. But in my opinion, one of the things that I didn't do as well as I should be is I needed to know more about the financial metrics that we're going to talk about today than I did, and I had to learn them the hard way. I talked to a lender one time, this has been a few years ago, and he said, if I can tell more about a business's health by looking at the financial reports than the business owner, I'm not going to offer them a loan. And so basically, the numbers that we're going to talk about today are numbers that will help you understand exactly what's going on financially within your business. And if you don't, if there's something you don't understand, talk to your accountant, your CPA, or some other trusted financial advisor who should be able to explain these metrics to you. And if you have an accountant who's not willing to, then maybe you need to think about that a little bit, because as the business owner, these things we're going to talk about today are all things that you need to intimately understand. So I've coalesced this into 5 financial metrics that everyone needs to know, and we're going to talk about them all individually a little bit. But income, expenses, cash flow, and your accounts receivable aging and your accounts payable aging are 5 critical things that you need to be well aware of what's going on. So let's start with income. P.T. Barnum said, without promotion, something terrible happens. Nothing. And I think that goes the same for small business owners. Without income, something terrible happens. Nothing. You need to make sure that you have adequate income. And I think it starts by keeping track of how you're doing on a yearly, monthly, weekly, and even daily basis. I liked to be able to compare the current year to the previous year, but that wasn't enough. I needed to know how we are doing in August of 2017 versus how we did in August of 2018. How did we do in the 4th week of the month in August this year versus last year? And even how are we doing from day to day? So I kept track of all of that information so that I could identify if there were trends. It not only helped me understand if business wasn't doing as well as it needed to do, it also helped me recognize positive trends so I could make decisions about when to invest a little extra into the business, when to do a push to keep the ball rolling, those kinds of things. So income is really important to keep track of. Expenses is the second big thing that you need to keep track of. What does it cost you to do business? And there are many ways that you can categorize your expenses, and this includes more than just what are the cost of goods sold. This includes things like your office supplies, toilet paper, paper towels, the sweeping compound that you use in your warehouse. What does it cost you to do business, including your rent and the leases or the payments on your vehicles, all of those kinds of things, because at the end of the month, at the end of the year, you want to make sure that you're generating more income than you're generating expenses. So it's important to know just exactly what your expenses are. I would suggest that if you haven't already done so, talk to your CPA or accountant and decide how you want to categorize those expenses, because the cost of goods sold and the general office supplies would be in 2 separate categories. And although you need to keep track of the total number, you also need to keep track of individually what you're spending on the different categories, because it is possible to spend too much on things that aren't generating income for you. Cash flow. Cash flow is king, is something that I learned as a business owner, and it's said over and over again all over the place. And having adequate cash flow to run your business is more than just, do I have money in the bank at the end of the month? So do you know your cash flow metric? Cash flow is a ratio of assets to liabilities, and a 2-to-1 ratio, so twice as many assets to liabilities, is the ideal. It's a really challenging metric to meet, but anything below 1-to-1 should be a big red flag for business owners. So we're going to talk about how this is important in just a second, but let's do another poll right now. So do you know what your assets to liability ratio is? And it looks like about half of you know the metric for your business, and about a third of you are going to do the math after this is done. That's awesome. So I think we can close this poll. This is a really important metric for a lot of reasons. For example, if you look at assets and liabilities and this ratio, let's say that you're a business owner that needs to borrow money to fund an expansion. Well, that loan payment and that loan becomes a liability and needs to be factored into your cash flow metric, because if that loan payment is going to pull your cash flow metric down below 1-to-1, you could actually be borrowing yourself out of business. So this is one of the most important metrics to understand, because it tells you, do I have money to invest in inventory here, or do I have money to pay for expansion? Can I afford to borrow money? The thing that popular media would have you all believe that the answer to all of your problems is more money, and that's not necessarily true. You need to be aware that you can borrow yourself into trouble and that money isn't the only answer. So I'm really pleased that 35% of you that are not familiar with where your business falls are going to do the math after this is done. Accounts receivable aging. This was a big metric for me in my business. Do you know, do your customers always pay in cash? Do you offer them payment terms? Do you know what the average aging is? For example, for me, in my business at the time, I actually started losing profits at 45 to 50 days. So if I gave a customer 30 days and they took 45 or 50 days, I was basically a break even on those customers. If it went over 65, 70 days, I was going in the red. It was costing me money to do business with those customers. So your accounts receivable aging is critical to stay on top of. And I also noticed that if I let an account get to 80 or 90 days past due, my ability to collect on those invoices became exponentially harder. And so as a business owner, it was really hard for me to call up a customer and say, hey, look, you're getting really old. I got to get payment on this, because, invariably they would say, well, I'm going to stop doing business with you then, right? There's a percentage of customers that would do that, and nobody wants that to happen. However, if they're regularly going 90 days past due and it's costing you money to do business with them, your business may be better off not doing business with them. Now, I don't know what the metric is for your business. Maybe it's 120 days, maybe it's 60 days, but you need to determine the impact on your cash flow, and because your accounts receivable aging should be factored into that. Pardon me. Excuse me. And so you need to figure out for your business, how many days can you go before you start losing money on a small business customer? And accounts payable aging is another one. Do you have vendors or suppliers who offer you payment terms? This is a great way to do a number of things. Number one, if you're a new business and you've been in business for less than a couple of years, this is one of the easiest and most efficient ways to start building your business credit, because it's relatively easy to get. And if the vendors and suppliers who offer you payment terms report your good credit history to to the appropriate business credit bureaus, it helps you build a track record and a history. So when you do need to borrow money and get a small business loan, you can. However, staying on top of your accounts payable aging does a couple of other things. Usually, when a supplier or a vendor offers you payment terms of 30 or 60 days, they often offer a discount if you can pay that invoice quickly. For me, it was regularly a 2% discount if I paid the invoice within 10 days. And this is a great way to capture extra ROI for your business. I know of a couple of small business friends who actually come pretty darn close to making part of their payroll with the discount terms they get from their accounts payable vendors. So if you can pay ahead of time and stay current, it boosts your credit profile with the business credit bureaus, and it gives you an opportunity to take that 2, 3, 4, whatever percent your vendors offer you and do other worthwhile things within your business. I'm not suggesting that you make payroll with it, but I know some guys who do. So working on your business requires that you know what's happening in your business. It requires that you have a complete and thorough understanding of these 5 metrics and how they will help your business understand, help you understand just exactly what's going on in your business, so that when you're making decisions about allocating resources or expansion into new markets, you can make informed decisions. Now, if you have questions, your CPA or accountant or another trusted financial advisor would probably be more than happy to talk you through this. In fact, if you have a CPA do your taxes every year, maybe it's time to expand that relationship, make it a little bit less transactional, and leverage some of their expertise to help you make better informed decisions as a small business owner. If you'd like to learn more about this topic, we've written about it at OnDeck.com. There are several articles that can give you some insight into this if you go to OnDeck.com/resource center. And we'd love to have you join us there and learn more. And now we've got about 5 or 6 minutes. Are there any questions that I can answer for you?
All right. Thank you so much, Ty, for all that amazing information. So we're just going to start the Q&A from here, and we'll give you guys a couple of minutes to write in your questions. There was one question that came in a little bit earlier, and this has to do with the 2-to-1 ratio. So the question is, the 2-to-1 ratio seems to be impossible to achieve. So between 2-to-1 and 1-to-1, are there any tools or metrics to help you measure how you're doing in that space in between?
You know, the 2-to-1 metric is probably the ideal, and it is difficult. Not many businesses actually make that. But that's one of the reasons why your income and expenses is so important, is because that's going to help you narrow that metric down to something above 1-to-1. 1-to-1 is break even. That, you know, basically you're not paying yourself anything as far as the business owner. You may be making a salary, but there aren't any profits in the business. Below 1-to-1 is losing money. So, you know, basically you just want to maintain controls on your expenses and generate as many profits as you can. So if your cash flow ratio is low and you want to boost it up, it may require raising prices. It also may require being a little more austere with how you manage your finances. For example, I grew up working in my father's small business, and his attitude was incredibly conservative, but it has informed how I look at things. And basically his attitude was, if it didn't add value or improve ROI somehow, he didn't spend a lot of capital on it, and he wouldn't borrow to do it. The only things he borrowed to do were projects that, maybe it was buying quick turnaround inventory at a discount, or if you were a restaurant, maybe purchasing, maybe expanding to an outdoor eating area so you can increase the volume of customers you have in the spring and summer. So basically, you're going to want to look at expenses and your profit margin and make sure that the margins are good and that they're profitable for you and that your expenses are as low as you can. And if you're at a 1-to-1 ratio now, the goal should be to incrementally increase that over the next year or two. And if your ratios are below 1-to-1, you need to get really serious about it. I hope that helped.
Okay. All right. Thanks so much. So another question came in, and it's a little bit specific to that person's problem, but I think it's general enough that plenty of business owners, especially when they're a little bit more on the starting out side, have the question. So it goes, just starting out, how can I figure out the amount I should be spending on marketing or inventory so that I don't generate more expenses than income?
Well, if you can create, if it starts with kind of a pro forma evaluation of what you think you can sell, and you're going to base that upon, your current customers and your marketing expenses are average probably about 10% of what your revenue is. And for new businesses, it's really important to look for inexpensive ways to market. I have some experience in a business with some partners, and we were doing some direct mail at the time, and we didn't have the money to do to work with an agency to do it, so we created it ourselves, and we sent out a weekly postcard to our list of customers that we collected, and we would actually print it on cardstock at Kinko's. I think FedEx is the new Kinko's, and then we would address them on Monday night at the end of the day, and I dropped them off in the mailbox on the way home. And like clockwork, every Wednesday morning, we started getting phone calls asking about the specials that we were offering in the weekly postcards. And we had customers who they started to regularly watch for that. And it made the phones ring on Wednesdays, Thursdays, and Fridays and worked really well for us. We did it on the cheap. It cost us postage and maybe $20 or $30 to put that together with a little bit of elbow grease. So you want to kind of look at where you're at now, and that percentage of income that you spend on inventory and supplies and marketing is going to increase as your business grows. So I personally am very conservative with what I'm going to spend. So I kind of would start with where are you at now and what do you think you can accomplish, and try to figure out the least expensive ways you can do it. Social media is another place you can do marketing as well. But I wouldn't necessarily think, okay, I want to do $100,000 this year and base my numbers on that if today you're doing $10,000 a year. So you want to be realistic and reasonable, and look at, if you're doing 10,000, what is it going to cost you to get to 20,000? And so look at where you're at now, what your revenue is now, and adjust accordingly. And then you're going to reevaluate next month and say, okay, this month we did X, next month we want to do Y, and make your estimates that way.
All right, thank you. Great answer. Just for the sake of time, we're just going to answer one more question, and this one is just pretty general that I think will help everyone listening, which is, do you have any good books or resources to help learn more about managing your finances, or any tools that can help a small business owner do that?
Yeah, there's a couple of books that you might want to look at. There's a book called Just Run It that a friend of mine, Dick Cross, wrote a few years ago, and it's a very simple way. It's a very simple explanation of how a small business owner should be running his business. It talks from the CEO's perspective, and or the business owner's perspective. That's a great book. Another book was written by Alan Bostrom, and he's a CPA. It's called In the Black, and he is going to dive into some of these metrics and why they're important, and talk about it from a CPA's perspective. And those are both great books to take a look at from the management perspective. Purple Cow, that was written by Seth Godin a few years ago. That's another great book on how to build products and services that are going to set your business apart. And what do you need to do there? So there's a couple of book recommendations, and there is a blog post on the OnDeck blog that I think is 33 small business books that every business owner should read. If you want to dive in and take a look at that list, that's got lots of great information there as well.
Okay. Well, we're just a little over time, and I want to thank all of you for joining us. And thank you, Ty, again for all that great information. And we look forward to seeing you on October 25th. And if you have any questions, feel free to reach out via email, and we'll be happy to answer them. Have a great rest of your day, and we'll see you soon.